Hello and welcome to the Capital Financial Group Q4 2021 Outlook video. We're going to dig into what's happened so far this year, and then we're going to move into kind of what we expect over the short term. Now, keep in mind, we are long-term investors here at CFG, but the current scenario, the current macro picture predicates that we get a little more short-term and tactical with some parts of our portfolios. So we're going to look at things through kind of a 3-month lens as opposed to looking a year and 3 years out like we traditionally do. A lot of that has to do with the fact that things have changed precipitously over the last year and a half with government intervention, with massive swings in the macro picture from a supply-demand dynamic perspective, with enormous amounts of stimulus, with growth, the growth pendulum swinging so far to the negative, and then extremely positive with comps being so easy earlier in this year specifically. Moving past fourth quarter of this year, all bets are off, right? Because comps are going to be much more challenging. So we're going to focus on the short-term time horizon. But before we get into that, we are going to talk U.S. stocks. This first chart we have is our major indices here in the United States. First, we have the S&P in purple. We have the Dow in gold, the NASDAQ in that pretty blue color, and then the fancy green goes to our small caps, the Russell 2000. Everything is up pretty handsomely so far this year, but as you can note here, and if you paid attention to the news at all, we have had a bit of a correction over the last month or so. Most of that has been driven by some fears, at least headline risk. But if you kind of peel back the layers of the onion, we saw a bit of stagflation. We had called for inflation slowing into the third quarter, and that's exactly what we got. Granted, it has reaccelerated over the last few weeks, and we're seeing that at the pump, and we're seeing that in grocery stores, but that's not what I'm talking about. I'm saying, why did we have this correction? And it's not just the headline risk, it's the fact that we were in a stagflationary environment. We saw inflation slow just a little bit on the margin, but it didn't actually decline. And we were expecting it to slow down more than it did. It plateaued. It didn't decline. Okay, so it was still at a very, very high kind of 5% CPI type of pace, which is high historically speaking, and we saw growth slow in the third quarter due to the Delta variant and a bunch of other stuff that was going on. All things that we kind of predicted, at least to some degree on the margin, which is why portfolios had a tendency to hold up better than the markets, especially during the most recent drawdown. So that was a good thing. We saw numerous corrections in small caps throughout the year, but this was the first 5% drawdown we've seen in large caps. So that was kind of telling. It kind of reminded people that there is volatility in the marketplace. Okay, so what we're going to do is we're going to move on to internationals. Really, really interesting asset class because things are diverging on a very country-specific basis at this point. We made a call in the last video that we were expecting internationals to continue to trend to the upside. I was wrong on that one. My intermediate term, next 3 to 6 months looking forward, I'm still bullish in that space, right? I think there's still some tailwinds for internationals. There's opportunities in internationals. But when we look at the EFA index, which is our big index that we like to kind of focus on for developed countries, that kind of is all of Europe, developed Europe, and then pulls in Australasia. So that's Australia, Japan, all of those developed countries. We saw some drama, just like here in the United States, over the last month and a half or so. We had a bit of a correction there. It went from being up 12%, as you can see on this chart. We had a very recent bounce, but it's down about 6%, a little over 6% overall. And that is telling because a lot of that is driven by some of the political drama that's happened in the largest economy in Europe, which is Germany. Chancellor Merkel not running for re-election and them having a splintered government. They're going to have to develop a coalition over the next few months, which is going to be challenging. Emerging markets still have all the tailwinds that we talked about last quarter. One thing that threw a monkey wrench into that recently was the strengthening of the dollar, and all of that was driven on the fear trade. There was a lot of fear in the last quarter. People go to dollars and they go to treasuries when there's a lot of fear, which I'll talk about here in a moment when I get into the fixed income piece. But we're in emerging markets right now, and the number one question I've been getting is what the heck is going on with China? Is this going to kind of bleed into the rest of the world with all of their debt issues? And the short answer to that is no. If we look at this chart, this is the MSCI Emerging Markets Index. It was going gangbusters at the beginning of the year. Absolutely bananas through the first quarter, and then it has given it all back and then some, which is not super exciting, but you have to keep in mind China is the largest component of this index at about 35%, and they came out of the pandemic much faster, much more aggressively to the upside than every other country in the world because, I mean, frankly, that's where it started. And they were prepared for it, so they had an advantage coming out of it, and they've had problems since then. Being 35% of the index, they've really dragged it down, and the peripheral countries around China have also suffered because of it. To that end, let's talk contagion, because that's the question that I've been getting. It's been all over the news, CNBC, CNN, everything. Whatever you guys watch to get your financial news, all they talked about for about a week to 2 week long period is all the problems in the Chinese banking sector. I want to be very, very clear here. Developer loans are the driving problem. That is the big issue. That's this Evergrande thing that everybody's freaking out about. Bottom line is developer loans only account for high single-digit percentage of total loans in China. And if we kind of peel back the layers of the onion even further, no single property developer represents a double-digit percentage of the total property market. Okay? So while it seems nasty, they're throwing around huge numbers like $300 billion, $500 billion, blah, 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 blah. The bottom line is that's not even denting the overall debt structure in China. Okay, you have to keep in mind China has spent trillions of dollars on infrastructure over the last 20 years. Most of this stuff is Communist Party subsidized. We have to remember that in their thought process, all they're worried about is common prosperity. That's the phrasing they like to use. And the Communist Party is not going to sit around and watch residential home prices crater, because that is the single most important asset class to a Chinese citizen, is their home value. Moving into fixed income, treasuries, we nailed it. I normally don't talk about nailing calls, but we nailed that one. We said that things moved too far too fast. Treasury yields got out over their skis. At this point, we think it's the pendulum's kind of swinging back the other direction, but yields did come down. They went from about 1.75 on the 10-year to about 1.2. Would have been a great time to refinance, right? But in any event, they're going back the other way again, and there's probably a reason for that, because we're going to get some tapering in November or December. At least that's what Fed Chair Jerome Powell was saying to us, and I think he's probably being honest. I mean, frankly, he should probably raise interest rates, right? I mean, who likes paying $5 a gallon for gasoline? But that's a story for another day. All right, so let's get into a Washington policy update. Dumpster fire, it's a mess. Yes, it is. It is such a mess. It's almost comical, right? It's like we got to sit back with some popcorn and watch these people just like go to war with each other. It's crazy. The Biden administration has completely lost control of the Democratic Party. Regardless, it looks like some sort of stimulus is going to come by the end of the year. Not really sure how much. It could be 3.5, it could be 4 trillion, it could be 1 trillion. Realistically, they could probably push through the infrastructure bill with zero issue right now. They just can't fit in any of the pet projects like green energy, funding for particular universities out there, and a bunch of other stuff that they want to throw money at that doesn't really have anything to do with the pandemic. The other thing that's probably likely to happen before the end of the year is we're going to see taxes go up. Nothing's really set in stone at this point. One positive I would say is that from an economic perspective, this plan that's being floated right now is way less aggressive than the original plan was 6 months ago, when I got like 50 calls from clients over a short period of time freaking out over capital gains and everything else. It looks like everything's going to be dialed back. Happy to go into more detail during a review, so reach out to the office to set up one of those reviews. We'll talk about the tax plan, what we've done already this year to kind of get ahead of it, etc. Moving into current positioning, because it is my favorite part to talk about. Cash levels are flat. Not doing anything with our cash levels. We're going to kind of keep them on a low level, relatively speaking. Traditionally, I view it as an asset class. I have carried high levels of cash. I've carried zero cash. We're going to be in the low quadrant of that, somewhere in the 0 to 5% kind of across the board. U.S. stocks, we're going to lighten up on quality. We're going to do the opposite we did from last quarter. We're going to tilt back towards growth in that space. International and emerging markets, mind you, ex-China, because I don't like all of the crazy drama in China. They're going to remain overweights. On a relative basis, we haven't seen this much value internationally and in select countries in a very, very long time. Fixed income is going to remain about the same, but we're going to tilt away, or I should say we already have started tilting away from the traditional bond classes, and it's going to get more prevalent over the coming months. And what I mean by that is we're going to go to non-correlated yields, things that aren't just treasuries and investment grade corporates. We got to find other ways to get that non-correlated asset class involved in portfolios, because we're always going to have some bonds. Remember, data dictates our positioning at CFG. I always reserve the right to change my mind. That's the beauty of discretion. As the macro picture changes, the investment strategy changes. I appreciate all you guys who have made it to the end of this video. I love doing these things. I love sharing my thought process on camera here for you. So hopefully this was fruitful and you've learned a little bit. Reach out at info@cfgfinancialplanning.com if you want to hear some more information, or give the office a call to schedule a review if you are an existing client. Thank you guys so much. Have a wonderful and safe holiday season.